Good morning, everyone. Thank you for coming here today. Thank you for joining the session. I think we are going to start. So thank you, everyone, for coming. I'm honored to have your attention for the next 35 minutes. My name is Caroline Liu. I am your speaker today. I'm here first and foremost because I'm really passionate about payments. I've been in the payments industry for some while. I started at American Express. When I started at Amex, I did various different roles. So I started on the small business lending side, and that was really interesting because 40% of the small business owners in the US actually use Amex cards as their primary source of funding. And then I helped Amex launch the first personal checking account and debit card. The product launched in February 2022. And after the product got launched, I stayed on the team, but then my main responsibility became managing the fraud risk for that checking account. And I put in the first-party fraud guardrails on the product. And then I joined a small New York City-based fintech in the risk and compliance space. Soon I will be joining SoFI as part of their fraud prevention team. So our main topic today is from crisis to control, how to guide clients through fraud attacks. The presentation will have 4 parts. So we'll first start by answering the question, how do we even spot a fraud attack? And I'll talk about different types of fraud and how do we address each type of fraud. And lastly, I'll leave 10 minutes for Q&A. So let us imagine you are Berkey. You are a fraud analyst at a regional bank. So the regional bank you work for started as a brick and mortar business. It expanded over the years to serve the local community. And when COVID hits, it opened up its first online application channel, which allowed the customers to apply online. On a normal day of the week, you receive about 130 applications. Out of the 130 applications you received, 100 got auto-approved. So that means the approval rate is about 75%, which puts you on the higher end of the spectrum among your peers. About 5% of the applications got pended, so they go into a queue called menu review, which means someone in the operations team in the underwriting department will pick it up later. And the purpose of menu review is to have a human pair of eyes to check if everything makes sense. Then lastly, 20% of the applications got straight to decline. And those applications got declined because it triggered various rules during your onboarding process. So imagine you're Berkey, you log into your computer on Monday after your first cup of coffee, and you feel really reassured since everything seems normal. Then Tuesday flies by, you have 3-hour-long meetings, you have to work on projects, and then Wednesday, you receive a curious email from someone who works in the operations center. You received an email from one of the customer representatives. She emailed you and she stated during her shift today, she received 3 phone calls from customers who claimed that they found they recently opened an account with the bank, but in fact they didn't. Our protagonist, Berkey, is an experienced fraud analyst, so it triggered an alarm in her mind. She set off to investigate more. She doesn't know too much information right now. She doesn't know how many applications are approved, denied, or pending. She needs more information to know if it's a coordinated fraud attack or a lone wolf operation. Berkey immediately started to pull some numbers internally. She noticed a jump in the application volume on Tuesday and Wednesday. The approved volume seems to be so out of range of what this regional bank normally operates in. She quickly escalated this issue to her supervisor. Her supervisor talked to the leadership. So by Friday, the bank shut down the auto-approval channel. Shutting down the auto-approval is a very common tactic, but it's costly because it means you decline both the good and bad applications at the same time. Berkeley did a really good job in this case, but here's the main pain point. 2 precious days have elapsed from detection to taking action, and time is precious when fighting fraud. So is there anything the banks or financial institutions can do proactively to save time? To answer that question, I think let's review what information financial institutions gather and collect during the onboarding process. During the onboarding process, for every application, there are 6 key basic elements: name, email, phone number, address, social security number, and date of birth. Some institutions or fintechs also collect information on device and IP during application. But among the 6 main basic elements, in my opinion, email is the hardest one to fill. It's really easy nowadays to create a fake email address or a junk email address. But due to the digital nature of those products, the fraudsters typically need to fill in an email address they have access to and they control, so they can start spending immediately. So fraudsters can purchase all 6 basic information on the dark web, but when it comes to application, fraudsters often need to swap out the victim's email address to an email address they access and control. And this replacement triggers a red flag. As for device and IP information, sophisticated fraudsters would use VPN to create a different login history and swap devices between applications. Lazy fraudsters don't care to switch device and IPs. So if you're a developer and you wanted to build a system that will alert when the fraud attack happens, you first would go on and collect all those information, and then to monitoring for repeated information, especially elements across emails, IPs, and devices, can be a game changer. If you notice a significant deviation from the norm, it should set off an automatic alert to your risk team. Are there exceptions? Yes, internal and external factors can mean you have to fine-tune your thresholds. I start with the internal factors. For instance, I've worked with a credit union and a regional bank that they still have an in-branch presence. And for customers that walk into the branch, they don't collect email information. But later, this regional bank actually resubmitted the same information again to an online digital chat channel, and they auto-filled the same email address for every application. So in this case, you would get applications from the same emails and IPs, but you need to be careful not to falsely mark them as fraudulent. And then I'll talk about external factors. If you are launching a marketing initiative, which is expected to attract a lot of new customers, then you need to tune your thresholds to avoid false alarms. So just to summarize, monitoring for repetitive elements across emails, IP, and devices can be a game changer. If your institution's baseline stats is about 20% of the applications come from the repetitive elements, and suddenly you notice that number increased 3-fold, both in the absolute percentages and also in the volume, then it should set off an automatic alert to your risk team. It should go directly to people's email inboxes or trigger a Slack notification. Now let's shift our focus to different types of fraud. So here I would focus mostly on first-party fraud and account takeover. First-party fraud and account takeover, they're both rampant in financial industry nowadays. First-party fraud means genuine customers who have the intent to defraud financial institution. And it's really hard to detect first-party fraud during onboarding because they are not stealing someone else's identity, they're misusing their own identity. And some of the common tactics, such as identity verification, asking for a selfie ID, asking for document uploads, or even trigger multi-factor authentication, don't work because the fraudsters have access to their own identity. So what I found through my own experience fighting first-party fraud is to dig into the linked bank accounts. Before I talk about how we can get insights from the linked bank accounts, I have to quickly recap about customer lifecycle. So a customer lifecycle starts with onboarding. A customer applies digitally, and typically within 60 seconds, the application will got approved or declined or get pended. And if the application got approved, then the next thing is linking external bank account. So the customer will need to link their own bank account to fund the product. And here, the two main ways people do it. The first one is instant account verification through Plaid or Yodlee. So in this way, the customer type into their username and password, the data aggregator usually apply, get that information, and verify it with your own bank account. And the second way is manual entry. So in this way, the customer types into their account number and routing number. And typically, that information goes to early warning system, which is a consortium that's jointly funded by the 8 largest banks in the US, such as Wells Fargo, Bank of America, Chase. In this case, you would both get information from the data aggregators linked bank accounts transaction history. And typically, you would get 6 months of history on the linked bank accounts. And I want to talk about what are the things you can look for in the linked bank accounts. The main insight I want to provide is the first-party fraudsters generally don't use their primary banking relationships to commit fraud. They typically use a secondary bank accounts. Why do they use secondary bank accounts? There are 3 main reasons. One is they want to avoid personal risk. Fraudsters don't want to face severe implications by jeopardizing their primary banking relationships. They are smart and calculated. Second is to exploit neobanks and fintechs. Modern banking has made it very easy to open up multiple accounts, especially with the neobanks and fintech companies. These platforms provide an easy way for fraudsters to open up multiple online bank accounts, sometimes within minutes. And lastly, they want to commit fraud safely. Some of their secondary accounts are used exclusively to commit fraud. Fraudsters treat those accounts as disposable, easy to open, easy to abandon. So as a financial institution, as a developer, once you set up the data pipeline and gather the information back from the data aggregator, such as Plaid, you can do some analysis on it. And I want to talk about what are some of the good trust indicators and what are the bad risky flags that indicate potential risk. So I start with the left-hand side, the good trust indicators. The first one is direct deposit and payroll. Accounts that receive direct deposits and payroll are typically good accounts. Based on that information, you can verify who the customer's employer are. You can check if the employer is legitimate or not. You can verify the income. And most people only have one employer. So if the customer linked an external bank account that they use to receive their paychecks, that's a vote of confidence on a product. Second one, donations. This one is odd, and I've never seen anybody mention this, but it works. Typically, charitable donations don't show up on fraudsters' transactions. Fraudsters don't donate. So in this case, charitable behaviors do correlate with good behavior. And on the right-hand side, I want to talk about the first point, which is exclusive P2P transactions. Those are the bank accounts exist primarily to move money between individuals. I've seen in my own real experiences, bank accounts that only have peer-to-peer transfers on it. Most of those transfers are on the Cash App platform. Cash App is a beloved fintech app that I use quite often, but because Cash App has made sending money to people so easy, it's also prone to fraud. The second one is ACH and check reversals. So accounts that has a lot of returns on ACH and checks are risky because reversals are a sign of fraud or insufficient funds. And lastly, there are a lot of companies out there that offer paycheck advances services. Basically, you can sign up a paycheck advance service and you get access to $50 to $200 on your next paycheck earlier. And when your paycheck hits, that money would get deducted from your paycheck plus a fee. Customers who seek frequent paycheck advances may not be the customers you want to have a relationship with because it indicates they are cash stripped and they are also credit hungry. So what's crucial is as developers, you will be collecting data and have sufficient data around those attributes. And then your analytics and engineering team can build capabilities using this set of attributes. So the summary here is first-party fraudsters won't want to face the severe implications by using their primary bank accounts to commit this type of fraud. They capitalize on the ease and convenience offered by the neobanks and fintech companies. They strategize to insulate themselves from the consequences by keeping their primary banking relationship intact and separate. I'd like to hear from you guys later how your financial institution has been dealing with first-party fraud. Have you seen similar patterns, and are there any unique flags you leverage? Now let's move on to the second type of fraud, account takeover fraud. Account takeover fraud is rampant with online account takeovers, account phishing, and hacking. Fraudsters use compromised credentials to transact and steal funds. I want to first talk about how an industry leader such as American Express tackled this type of problem. So at Amex, to sneak out logging fraud, Amex recently developed an end-to-end machine learning platform, which at an account logging level can predict the logins from a genuine customer. Logins that are scored at high risk will be required to do additional verification. It will trigger a step-up authentication request, where logins from low risk can get a seamless online experience. This ensures bad actors are captured in real time while good customers are minimally impacted. To develop account takeover model involves a lot of challenges. The first major hurdle was data. Amex needed a vast amount of logging level data to train the model. Most of financial institutions collect data on the customer level. So the first challenge Amex was able to overcome was integrating data at the logging level to a machine learning training platform. And then each login needs to be scored in real time by the model. The machine learning model needs to access all the information, including the most recent information, and produce a response in real time. This is no small endeavor. Then the performance of the model needs to be tested rigorously. The hit rate of the high-risk logins needs to be consistently higher than the response produced by the existing structure. And this performance needs to be stable over time. So this is the reason why Annex consistently produced the lowest fraud rate in the industry, they have solved this problem, they have put in a lot of resources to develop machine learning capability in real time. When fintechs join the battle, not all fintechs have access to such well-trained real-time machine learning model. So as an alternative, I want to provide you ways that you can leverage the domain expertise and to help a fintech identify high-risk logins based on static inputs. So I wrote down a list of 5 useful attributes here. I'll start with the top, geolocation. So for each login, you would collect the information on login's geolocation, and you can track and flag logins from unusual locations. Second one is the velocity. You want to monitor the speed and frequency of logins. And the third one is the behavioral change. So fraudsters typically would initiate a PI change prior to funds transfer. So you can issue alert if the personal information, such as the email, phone number, change prior to a large transaction. The fourth one is network analysis. So we typically see the fraudsters would use 2 bank accounts to power 300 different customer profiles, and you can identify logins using the same IPs and devices. And lastly is transaction history. So you can flag transactions that are outsized in terms of frequency and dollar login. Those domain insights are valuable because they can be implemented without a complex machine learning model, allowing easier modification and testing. So on this slide, I give an example on how you should structure data. So here, each row represents a unique customer, and each column represents one aspect of the login information you capture. And you can keep adding the columns on your customer's subsequent login attempts. So for instance, you have a customer who typically logs in at LA around dinner time, and the preferred way of logging is through biometrics. And then you observe in the subsequent login, the location became like Pakistan in the midnight, and the customer switched to the traditional username and password types of login. So by structuring data in this way, you can calculate like the changes in different times, stamps, login types, and distance between each login attempts. So in conclusion, rule-based fraud solutions work. While machine learning and AI are buzzwords in our industry, the reality is many fintech companies lack the robust models required for real-time fraud detection. And from my conversations with government officials to tech leaders in the tech companies, one thing I've heard is rule-based fraud solutions work. They're less dependent on massive data, and they can be more transparent, allowing for easier modification and improvement. And crafting those rules is not just about understanding the data, it's understanding the behavior of the fraudsters. And hopefully today after my session, you will learn something about the behavior of the fraudsters and you wanted to implement with your team. And one last thing I wanted to cover is if today after you go back, you want to implement it, how can you most effectively implement the solution? So in my opinion, this framework works the best. And I happen to know Stripe also uses this framework in their solution. So typically you have product manager, risk manager, and data scientists in your organization, regardless of your size. In my opinion, the product managers are the ones who define the framework. So they define what problems you're going to solve and how you're going to solve it. And then they define what the success is looking like, and they track your progress towards the goals. And then the risk managers supply the domain knowledge. So risk managers typically have a lot of firsthand experience fighting fraud, and they are proficient in SQL. So where risk managers typically use SQL to do preliminary analysis and to hone in a set of highly effective data attributes. And then the data scientist query the data in the way defined by the product managers and risk managers. And then the data scientist then would deploy it into production. In this way, it's really clear on which team's doing what, and it's a very collaborative effort instead of one team comes up with end-to-end machine learning model by itself. So with that, I want to thank you for attending. Thank you for all the sponsors from Moov to the team, the staff for working in session to make it possible. And I'll leave 10 minutes to Q&A. Yeah.
Just a basic one. It's a really good, clear concepts for rules on the different export acts. The slide deck, I know they're going to get out for everybody. Let's go an easy way to get your slide deck or a copy of that.
I believe so. The whole presentation is recorded and will be uploaded to YouTube. I can check in with the conference organizers to see if I can share it privately. Yeah. Go ahead.
Amazing presentation. Thank you so much. For startups that don't have the resources to put together that framework we were just talking about, do you have some industry knowledge on third-party tools that can provide that ML and AI for bot detection?
Yes. So the question is for startups that don't have the capability or the resources to train machine learning models, are there any third-party vendors that will provide transaction scoring? Yes, I'm aware of plenty of vendors, and they're probably dying to talk to you today, but I've been told this is not a sales pitch. I don't want to give a biased view on this, but I'm happy to talk to you about the vendors. Go ahead.
So for some of these fraud detection metrics, do you have a way of making sure that they don't end up being like racially biased? So you don't want to say, oh, we identify minorities as being high fraud targets because that's wrong.
Yeah, diversity and equity is very important in financial institutions, especially has real-life consequences on people's lives. I am aware that for a lot of the models that are being developed, they're really conscious about reducing the biases, starting from the data, because the data used to train machine learning models, unfortunately, would show you high incidence of like certain population committing fraud and certain demographic group. So if the data is biased and the model is also biased because the past somehow influences the future. I think the good thing about fintechs and why I'm in the fintech industry is a lot of fintech industry and companies, at least their value proposition is to serve certain minority groups. So you've seen a lot of fintechs that just serve like the LGBTQ communities. Unfortunately, a lot of those fintechs that box themselves into very small demographic population have not been doing that well in the past year because most of the needs are also universal and can be served by like the large banks. So that's like a really interesting question. And also I was talking to a friend at Meta and he informed me recently there an even more scary type of fraud, which is to use ChatGPT and AI to purposely modify, say for instance, Wikipedia articles. So if your model is trained on open source and trained on like data you collect on the internet, the fraudsters can, once they figure out the frequency you train a model, they purposely change the information to wrongful information prior to you update the model. So those are some like continuous challenge we need to solve. Yeah.
Are there any legal or policy problems with scanning people's flash transactions on connecting their accounts? I don't think dealers are expecting people to necessarily do that in a connected lab. And the second part of the question would be, is that such an effective fraud prevention tool in your mind that companies that don't require a cloud account on sign up? Is that something that we should do?
Okay, yeah, so the first question is when you get the data back from Plaid and you want to analyze the transactions, are there any legal and compliance concerns? And the second reason I think you're asking, is Plaid or other data aggregators so effective that every fintech company should push to integrate that? Is that?
Require users to sign up and find those accounts just so we can scan this data.
Yes. So for your first question, I'm not aware of any legal battle against utilizing those information. I think when the customer link the account through Plaid, you have to consent the information. I think there's a consent box at the bottom if you read it carefully. Handles all the legal repercussions. I do think linking external bank account is really useful, not just in onboarding and fraud. It also powers cash-based underwriting if your company is ever ambitious to go to providing credit limit based on the most updated bank statements, financials. Traditionally, a lot of banks still rely on revenue-based underwriting models. So if you submit financial statements, you got rated by an underwriter, and the rating goes from A, B to C to D, and depends on your letter rating, your risk rating. You would assign a percentage of your revenue from the last year to be your credit limit. But nowadays, I think most of the fintechs and even the big banks wanted to push towards the cash-based underwritings, just because the financial statements, the 10Ks, they're quite outdated. A lot of things can happen between the last time you submit the financials to the time you request a credit increase. So if you as a financial institution had access to the most up-to-date cash flows through scripting the financial statements, it gives you a lot more power. It gives you up-to-date information about the company and individual's financial health, and you can develop more fancy machine learning cash-based underwriting models. Go ahead.
Do you see a difference in fraud between people who are trying to like steal money versus people who just want to cause damage? So like someone wants basically they're like fortune and someone wants to steal money.
So the second type are just people who wanted to.
They just want to hurt you. Like they like let's say they know they cost you $5 in the background, so they spam you with applications to collect $dollars.
It's really hard for me to say. Most of the times, it's hard to understand the intent of the fraudsters unless you get a chance to talk to them and meet them in person. I do think most people commit fraud are the people who wanted to have any sort of monetary rewards. Otherwise, the cost is probably not worth it. Go ahead.
In the beginning of your presentation, you said that neobanks actually way more exposed to the problem of like fake accounts pretty much or burn accounts. Do you know any cases when bigger institutions pretty much see that customer using like some of the neobanks automatically being red flagged for that and just immediately like send it to support the problem?
Yes, so the question is really good. Have I seen any bigger financial institutions utilizing the sender-receiver information and just automatically blacklist certain institutions like neobanks who are higher risk? Yes, I've seen it. There's actually a Forbes article about Robinhood. So Robinhood has publicly banned a list of neobanks and financial institutions to be added as a funding source for the brokerage account. And if you Google that, you see a list of the financial institutions Robinhood has banned, and they're generally more higher risk.
You mentioned a tool, I think you called it early warning. Is that what it's called? Is that only available for those banks or for those four banks, or do they actually partner with other banks as well providing some of that data?
Yes, so I mentioned early warning system, which is a consortium actually created by the 8 largest banks in the US. They have a couple of different products. The most well-known product is probably Zelle. And early warning is really powerful because it has access, it basically has a God's eye view of all the transactions. And the ping in the ask for neobanks to use it is early warning actually don't resell it through third party. They kind of operate in a use it and give it model. So to use the data, you have to also contribute to the consortium. And they have a product called a deposit check and payment check. And the product is really powerful because it gives 3 informations. So the first data point is account owner AOA product, which is account ownership authentication product, which basically does the same thing like Plaid do, which is verify the ownership of the account that I'm linking an account that belongs to Caroline Liu. And the second data point they provide is actually account status code. They will give you a status code when the account is closed or open. And then lastly, they also give you a return probability score, which is like a probability indicating whether this ACH check will be returned. Okay, I think we are good for lunch, and I'm looking forward to seeing some of you guys at lunch, and feel free to keep in touch. Thank you, guys.